So today we're going to talk about money. So first off, welcome everyone. If you guys are, who's a first timer? Raise your hand. So about half, almost half the room. Awesome. I'm glad you guys could make it. This is our showroom for Icon Window and Door and Novo Construction. So those are our hosts tonight. I'm a owner in Icon, and Novo is our construction company, and they're phenomenal. So if you guys need any cards, hey Harris, if y'all need any cards, you can grab some Novo cards. They should be set out somewhere, probably at the front. And then if you need windows, don't hesitate to ask. I'll hook it up. All right. Let's see what we got. So we're just going to kind of roll through this, talk about, I put this whole slide together, and honestly, this is like a 5-hour thing, so I'll try and keep it moving, get to the good stuff, because it's at the end, and then we'll see where we go. I'll answer any questions along the way, and we might also have a couple guest speakers, so they don't know about it yet. It's going to be fun. So we're going to go over types of funding that we have that are available to us as investors, whether that's a fix and flipper, somebody partnering with another person to take down a deal, wholesaling. Sometimes you need to raise money for that. You need access to funds. There's tons of different ways that we can get access to capital that can help scale your business or actually get you started, especially new. A lot of new people don't know this. So, you don't actually have to save up 20% for a house. There's ways around it. You can do real estate with zero money down. Just got to know all the tricks. We'll go over some general rules and guidelines as well for that funding. So what different types, like hard money, conventional, DSCR, different types of, kind of how the outline goes with those. Common terms, interest rate, DSCR. I don't got to read all of these, but these are good to know. Well, we'll go through them throughout the night. But these all are things that you kind of learn once you get into the space. They're things that I didn't know when I bought my first house, but they quickly kind of become familiar to you after you start buying a few of them. How you doing, man? Does anybody have any questions on what any of these things mean? Don't be shy. Let's see. New guys, you guys know what DSCR means?
Debt service.
Oh.
Coverage ratio.
Debt service coverage ratio. There we go. How about DTI? Who knows what that one means? There we go. All right, so these are super. I actually put cash up there, and I was like, people know what cash means. Like, I don't need to put those up there. And then for some of the creative people, balloon payment. There's some cool stuff in here. We'll go through it all. So here's what we're going to go through. Obviously, you can just bring cash. You can just pay cash for properties, and that's some people's MO. They just save up money. They might have a good W-2. They just save money and buy properties one after another and then just pay cash for them. If you want to scale, that's obviously the slowest way to do it. So I'll talk about pros and cons to that. Conventional, credit unions, HELOCs, hard money. All right, so I got like almost the entire squad of Rehab Wallet here. So Rehab Wallet, if you wouldn't mind raising your hand. These are our hard money lenders. They're phenomenal, best people to work with ever. So I'll talk about them later, about what they offer. Private money, retirement accounts, syndications, all types of fun stuff. All right, so we talked a little bit about cash. So pros, cash. You go into an offer and you bring in cash. That's pretty nice. You can actually see like proof of funds and say, hey, I'm paying $200K for this house. It's going to close. There's not going to be any financing problems. It's super strong. You can write really strong offers as an investor or a flipper if you just have a couple $100,000 sitting in a bank. Not everybody does though, right? Like I didn't when I started. It provides freedom, super fast to close. You don't got to wait on anything. Nobody's telling you, hey, you got to meet these deadlines. You have to send in all these documents. It's just boom, hey, cash, wire it over, it's done. Then we're talking about some of the cons there. You're not getting the best return on your investment. If I were to buy a $200,000 house and it's making me $500 a month in cash flow, and all my cash, I have 200 grand in it, I can find, you know, better ways to spend 200 grand to make $500 a month. It's not the best use of your money. You could probably buy 6 houses with 200 grand, and then you can bring in $500 a month on all 6 of those. So that's just kind of the thought process on your return on your investment, and then your leverage. You know, using leverage helps you get way more properties. So we'll talk about that as well. It's time consuming, right? Like, I mean, I don't know. I suck at saving money. So, I mean, I think I'd probably be, you know, 40 years old before I could save all that money. I would just spend it all if I didn't leverage my cash. What's next? All right. This is where everybody starts, right? Maybe you save 20 grand, enough for a down payment on a $100,000 house. You just want to get started. You're getting your feet wet. First thing people do is they go straight to they go to BB&T, Truist, Navy Federal, Bank of America, and they're like, I want a loan. I want to buy a second home. I want to buy an investment property. And then they're like, okay, submit all these documents. You go through all of that. You find out what you're pre-approved for. They look at, you know, your W-2, how much money you make, and it's a long process. You know, a lot of people own their own personal home here, so you just do that over and over again with your investment properties, and here's what it is. Some pros. Let's see, what else did I write up here? Yeah, so some things I wrote up there. They're usually your cheapest option as far as debt goes. You're usually getting the most advantageous terms. You're getting, you know, 5, 6, 7% right now. Who's closed a conventional loan recently? All right, Zach. So if you guys don't know, Zach Cooper's a loan officer. I'm going to have him talk for just a second, but he didn't know about it till 5 minutes ago. So Zach, what are the interest rates right now that you're seeing?
Anywhere from low 6s to high 6s for the most part.
Yeah.
Traditional investments might creep to 7.
Okay, yeah. So that's decent. I mean, I'm sure over a 30-year period, where, you know, last year in 2021, 2022, we saw 2s. I mean, that was historical. We're never going to see that again. At least that's what people say. It'd be cool if we saw it again. It's cheapest, yeah. You're not paying as many fees. So who knows what a point is in reference to loans? Tim, what's a point?
Percentage, 1%.
Okay, and how does that intertwine with like a loan? What does that mean?
It's the cost that they tack onto your loan that you have to pay back.
Yeah, so if you want, like, you can use points. Sometimes points are just a part of it, which where, hey, you'd have to pay 1 point, 2 point, just a fee somewhat, and you can use points to buy down your interest rate and, you know, help. It's kind of like putting your skin in the game with the lender. They're going to say, oh, he's got more points, more out of pocket, so we'll lower his interest rate.
Is that like, is a point actually something to do with the prepayment of interest that they would have received in a particular time? Is that how they're buying down the points or the interest rate?
I'll let Zach answer that in just a second. From my understanding, point is just, you know, 1% of the entire loan value, and they use that to, I mean.
Yeah, it's a risk assessment. You know, everything's, like I said, conventional loans are going to be sold in a secondary market, mortgage-backed securities. So whether it's investment properties right now, with a lot of the new rules and regs, you're going to pay points to get a rate as opposed to necessarily not paying points to lower your interest rate. It goes into that risk assessment. First thing you quit paying on your investment properties, the second home. So that's putting your skin in the game there. When you're buying down that rate, you're right in that sense. You know, you're going ahead and giving them a little bit extra because they're not going to make as much interest long term off of that. And the banks or the companies that are buying that in the secondary market, they're taking that into account and kind of setting what points will get you to what lower rate.
And Zach, if you wouldn't mind talking about this new thing that's coming along about seasoning periods.
So seasoning periods, yeah. So up until now, it's always been, you know, they want you to do a refinance. So you buy a property to do a cash out refinance. You do the renovations. It was 6 months to be on title of that home. If you buy it cash, like he had mentioned earlier, it's still 6 months. If you buy a house with a mortgage, do a bunch of renovations, now you have to wait 12 months before you can do a cash out on that. So if you had an existing mortgage, it's a 12-month requirement. Now that's brand new as of 2 months ago.
Even on an FHA 203K or VA 203K loan type of deal, like when you're done with that project, does it going to long-term at that point, or you're still?
So the 2 and 3K, yeah, that's gonna be, most people aren't doing that for flipping, but you're
Yeah.
gonna run into flipping issues if you're on the FHA side,
Yeah,
you know,
yeah.
reselling and things
For
like that.
renovation of their home, you know?
Yeah.
Yeah, okay.
So, why did they start doing that?
That's debated, but
Because if you go look at the records over the past 3 years and the people that have been buying homes across the nation, it's the percentage of investment purchases have skyrocketed. So the government has got back involved and they're changing some regulations to try to get first-time home buyers, primary residence buyers, give them an opportunity to get into the housing market. So they're making, that's why you also are paying points now on investment loans and second homes, whereas a year and a half ago you weren't. A second home was same exact rate as a primary residence. Now it's the exact same as an investment property.
So they were kind of like, the hedge funds are buying a bunch of houses. Were they doing the Burr method or something, or?
They just look at I can't tell you why the government
Yeah.
gets involved,
No, I
they get
understand.
involved, but yeah, that's why. I mean, it's just a massive influx of investors into the housing market for obvious reasons. Rates are at the all-time lowest. It's, you know, in a lot of people's mind, free money at that point,
Yeah.
so
That's-
take advantage of it. And
That's Fannie and Freddie backed loans, correct? So you might have a local bank that still may have a lesser seasoning if they don't sell their loans off. And
Yeah,
non-QM
they
lenders
don't,
still
yeah.
may do.
yeah, that's what I was going to talk about.
Yeah.
Yeah,
Oh,
so-
sorry, I didn't mean to steal.
No,
that.
no.
Okay.
Yeah, so I mean that's like the sky is falling, right? Like I have to wait an entire year to refinance my property. That's a long time. I mean, usually with transactional funds or temporary funds, you have that money for just 6 months, 9 months, and now we have this new requirement that makes you keep it for 12 whole months before you can actually get your capital out. So that slows first-time investors or new investors down. But in the real estate space, there's always ways around it. So, I mean, if you guys know the history of the government, they always try and put things in place, and usually it has an opposite effect. Investors utilize different types of loans. I haven't used a conventional loan since the first purchase of one of my properties. All my other properties are in different forms of loans. Dan mentioned non-QM, non-conforming. That's what I use because I use everything through my company, through a business, through an LLC. I don't use my personal debt on anything real estate-wise, and those don't have the same seasoning periods. Marinos?
This is a question for Rehab Wallet. Are you guys doing a year-long hard money loan, or? Because of this?
We'll consider it. Primarily, our loan terms are 6 and 9 months. Where we've been maybe a good 4 or 5 months now where we're offering the 9-month terms for that reason, for some seasoning purposes. But we prefer to help you out short term, but we can look at the asset and we'll consider it.
Okay. Can you refinance with, this might be a tough question. Can you refinance with a hard money loan? Or refinance with the lender that gave you the hard, like, can I refinance with Rehab World?
We are in the process, I think we've got 6 or 7 different banks, but we're in the process of creating relationships to help you, to broker it out, or to help you, and possibly for us to hold it longer term.
Yeah, true, you wouldn't wanna keep us long-term, it's too expensive.
Yeah, you wouldn't wanna keep the original one that we offer you under the current plan, because it's just too expensive.
But what if I got like a really good deal
Mhm.
and I wanna cash out? And, because I don't wanna wait the whole year
Mhm.
and I wanna just cash out. I got a really good deal, I still wouldn't wanna,
As long as the numbers work, yeah, we refi, we've done it before, or a paid-for home. That's considered a refinance, right? You got a house that's clear, free and clear, and we'll do a refi to get some cash out. So, same instance, if that's what you need to do, get the cash out short-term, wait a year. As long as you can, budget that cost during that year, yeah.
To get to your, I think kind of what you're getting at is hard money. We haven't got to it yet, but it's just really short. It's just transactional. It's not transactional, but it's temporary funding. It's really just, hey, I'll let you borrow the money for a little bit until you can find the actual exit strategy for that property. Exit strategy for most people, if they're holding it, is 30-year, 15-year debt. It's with not a real bank, but more conventional style bank, maybe a commercial loan, different type of loan. Some hard money lenders that I've worked with do have different sectors, similar to what Andrew's talking about, how they might be able to find new banks. They'll actually have different programs that they can refinance out their hard money, but it's not going to be hard money. It's going to be 30-year debt at that point. So.
The biggest advantage is we hope you get in there real fast so
Mhm.
that you have an advantage over other buyers because of how fast we go.
You said the seasoning requirements that are new this year either don't apply or they're different for going through LLCs or businesses?
Yeah, we'll get to that.
Okay.
Yeah, don't let me not talk about that, but that's correct. Another thing, when I was just getting started, I was listening to all the podcasts. They were talking about banks and getting loans, and I was just in that fear, just like the overwhelming analysis paralysis of getting into real estate. So one of the things I read was you can only get 10 loans. So I'm like, well, guess I can only get 10 houses. Like they just, stop, we're done. I can only get 10. Well, there's ways around it. So that is something that, when they sell these off, right, correct me if I'm wrong, there's usually about a 10 loan maximum with Fannie and Freddie, and then they kind of cut you off.
Yeah,
And
so
it-
that's just on the loans that are going through Fannie and Freddie that are going to be sold secondary market. Your traditional 30-year, 15-year, whether it's an ARM, once you start
Yeah.
doing stuff, commercial, he'll touch on going through businesses. If he came to me and he owns 20 houses, but through different entities, through LLCs and business, I'm not going to stop him providing a primary or a second home or something because it's not 10 loans against his personal account.
And it's you personally, so you and your wife can each have 10.
She owns my car, so we could get more loans. Got to always mess with that DTI there. All right, this is very similar to a normal bank, like a conventional bank, but it's just one more layer. This is, I was listening to those podcasts, Bigger Pockets, back in the day. They're like, hey, go find a credit union. They'll do all types of different, more creative portfolio lending. They'll do more than 10. So then, I tried to go network with those people and go that route. You also have small banks, which are same but different. Credit unions are a different thing altogether, and then small banks are just, small local banks. The way I kind of delineate that, and this is a cool metric that I heard when I was listening to a podcast, is they have 3 branches or less. They don't have a banking app. Go in there and talk to the banker. It's a trick. It's a hack. I haven't done it, but somebody told me about it, and I thought it was really cool. Because I don't really use this style, but it's super cool because they said go get a phone book, which was hilarious to me. Like nobody has those anymore. So they get a phone book, look in the banking section, look up how many locations they have, and find your local bank, and then go in there and say, here's what I want to do. Bring in a nice little packet and say, I'm an investor. I want to do this. Here's what I want to accomplish. They're going to be way more apt to partner with you because that's what that bank is going to do. If you say, hey, I got $100,000 cash. I'm going to put it in an account with you. I want to get more than 10 homes. They're going to sit down and talk to you. And that's kind of the thought process behind this. Let's see, pros and cons. More freedom, so you don't have those same restrictions as the conventional banks. My favorite thing is you're actually talking to the banker that's underwriting your loan. So you're not, with Navy Federal or wherever, when I got my first loan, actually, it might have been you did my first loan. So Zach did my first loan, talked to him. He was basically like an exception. He was able to kind of walk me through the whole process. But at some point, there is underwriters that we do have to answer to. So those are the people that you can kind of cut out of the equation in this discussion. You're just talking directly to that banker, Steve, hook it up, is what it is. More than 10, cons, maybe more expensive, might not be. Might be more affordable. It does take a little bit of legwork to find these relationships because you actually have to build the relationship with the bank instead of just calling up some random bank and then just applying. There is a relationship piece to that to allow that to happen. Any questions on that? Cool. All right, here's the This is like everybody's answer. This is hard money. Kelly beat me to it. She said we're expensive. That's what hard money is. It's expensive. But it's fast. It's quick. It's the same thing. That means the same thing. Yep. It's easy. I mean,
You just described us as fast and quick.
yeah, that's it. So you do that is the loan is secured by the property, so they are going to be listed on the title. You know, Rehab Wallet. They're going to have interest in the property. You know, they're not just going to give you the money and then you can run with it. They're going to get their money back. I've seen all the documents. They're getting their money back. They're taking your firstborn. But it's short-term bridge loans. It's just quick. You don't want to hold on to that because the interest rates are 10, 11, 12, 13% depending on what hard money lender you use, and 12% is more than 6 or 7, and that's expensive. So it's got to be quick. They're not usually banks. They're more of like a fund. I mean, Kelly, what word would you use to describe what Rehab Wallet is? Like an institution or like a private fund or what?
We use our own money, so we're a debt fund.
Okay.
So because we are able to use our own money, it makes us more nimble. Like Angela didn't ask you, it's not corporate America, so she didn't answer that question when you asked, can we do a year? We're nimble.
Yeah.
Like the asset, we'll look at it.
Yeah.
If we like you, we'll look at it. It's just we can be super nimble when
Yeah.
it comes to that, and we don't have to abide by the institutional powers and money because they're not telling us what to go get. So we're not going to be asking you for your W-2. We don't even pull credit.
Yeah.
I mean, I can't even really say this, but I'm glad I played basketball because I could never get my SAT score. Just was kicking me out, right? And so I just really have a hard time with scores. I just have a really hard time not scoring, but scoring. And so that when we started Rehab Wallet, we were like, I'm not pulling any credit scores.
Yeah.
I care about the assets. I don't care about SAT scores. I don't care about credit scores.
Yeah.
Somebody in here might not have credit scores. If you're a great person, you might just have a life situation that happened. And then when I was in the conventional business, the credit scores we'd look at sometimes, and it would be just a hospital bill that just was forgotten, and it crushed somebody's credit down below 600. And you're like, but everything else is great. I can't do the loan. So at Hard Money, at Rehab Wallet, we've changed that to make it super easy and very low documentation, and again, just more nimble.
Yeah. I've used Rehab Wallet personally in my business multiple times. Started back in 2020 with Rehab Wallet, and it's a phenomenal. It really is the best lending experience you can get. You talking directly to these ladies here. They're amazing. They say 3 days sometimes. At least they used to. I don't know what the time is, but you say if you give me all the documents.
We got all the borrowers.
This week that were.
Yeah.
And one came in today, we'll close in 3 business days.
Yeah. So, I mean, you talk about, hey, last minute, something fell through, can't get a loan, I got some money in the account, this is a great deal. That's who you're calling. I mean, they're making the deal happen. And it's not, she just said no credit. I mean, this specific hard money lender is a lot different than some of the other ones I've used or seen around. They just look at the asset. Angela, do you want to talk about, before I just talk about you guys?
That we're a asset-based
Yeah.
lender. We use our debt fund. There's investors' money who come in and trust us to lend it out. And we are for experienced investors.
Oh, that's a
So
good point.
We're going to, vet to make sure that you've done some deals before. But we're primarily going to look at that asset, because if something were to go wrong, we're going to step in and we'll finish the job, or we'll wholesale it, or sell it to someone. But did that answer the question?
Yeah, I mean, I think it just, there's a lot of people that are new that are probably going to look at hard money as a tool. So if you're new, first time, never done a loan, you have to partner with somebody, or you have to, when she says experience, it means you have done X amount of flips or projects as an investor, and they kind of look at that to see if you have the experience in order to justify or like qualify you to be able to get that loan. So hard money is one of the best tools out there in real estate investing, especially for flippers. Dan, have you ever had any projects run long? Any flips
That I've lent on or that I've
that you've been flipping? Have you ever had any?
Yes. So, yes.
Putting you on the spot.
Geez, yeah. No, I got one. I was just saying today. I think we calculated end of January and we're selling it tomorrow. So yeah.
Yeah. Yeah. So
It happens.
some of these projects they take a little bit longer, and you might have different debt on them, and just got to be nimble. You got to have different exit strategies when you underwrite, and make sure you can refinance out if you need to, or sell it, or do whatever. You wanted to buy things right. We talked about that. Oh, you guys let me die. We talked about that last week a little bit on how to underwrite a deal, make sure you get a good deal. That's kind of what we got. One of the pros I do want to mention is it's same as cash, kind of. It's like it's a loan, but when I write offers, I'll put cash, just because hard money is basically cash, and so just a little like trick there, so you can have a really strong loan without having to like have a pre-approval letter unless they require it. So.
And we can provide a proof of funds letter.
All right, this is the space I'm operating in right now, the DSCR space. So what I do is I'll purchase my flips with hard money or private money that I haven't talked about yet. So I'll purchase my flips, and then I refinance these things. I guess they're not flips, they're buy and holds. That's what I really meant to say. I'll refinance them into a DSCR product, which basically means you're looking at how much money the property brings in over the expenses, or the mortgage payment rather. It's kind of like calculating what your debt service coverage ratio is. That's what that means. So I don't think I incorporated that slide that I looked at, but DSCR is like a little equation. It's like DSCR, and then you have your expenses over or income over your expenses, and that's just kind of how that works. It's usually like a ratio of 1. So if you're...
Question just whenever.
Go ahead.
Do you ever run into issues where you can't get the asset qualified yet because you're not pulling in income yet?
Exactly. Yep. No, definitely. Yeah, so that's, where is it at? Yeah, so that's this one right here. So uses long-term rents for the income. That's what most DSCR lenders look at, is what's the long-term rent rate in that area for that house. So it's kind of speculative. They'll send an appraiser out, and then they'll say, hey, market rents in Park Circle are $1,800 for a 3-bed, and you're like, people on the street are at $2,400, and you're just like, you're kind of just stuck. That's one of the cons, I would say, is they want to look at the income. So if they're writing the loan, it's either you have a lease in place and they use that, or they're looking at market rents from an appraiser. So that is definitely one of the things that'll stop you from getting a loan.
More are going to short-term rentals, so a lot of the appraisals on that now, just because we just did one recently, we can't look at short-term rentals. We just have to ask the appraiser to do that evaluation as opposed to long-term, and whatever they put on there, though, we're still stuck with, like you said, so we go off of that.
Yeah, so I use this. One of my examples, I just refinanced probably about 3-4 months ago. I had 2 properties in Park Circle, if you guys are familiar. They're short-term rentals, and I actually used a DSCR loan, and my lender actually combined the 2 properties into one loan, which was cool. So I had one set of closing costs. We looked at both loans, appraised at the same time, did everything together. It was a great process. I'll share that company with you guys if you guys want to come find me afterwards. But I forget where I was going with that. But yeah, let's see.
Zach, can I ask you a question?
Yeah.
Are you seeing that institutions are allowing one LLC to do a long-term rent on the LLC that holds the property, basically like an arbitrage, and then the short-term rentals through the second LLC, so there's actually a long-term lease signed on the asset. Is that allowable?
I have not seen that.
Because I know people are playing that game a little bit, and it also helps with liability. Okay, I didn't know if that could help. So basically, you have two different LLCs. You have the holding company, so XYZ Holding Company holds it. And then the ABC, your other company, signs a long-term lease with XYZ, kind of like an arbitrage. And then the ABC will short-term rent the property, but pay a long-term money to the XYZ Holding, and then therefore you have a long-term lease that you could, A, it helps with liability, but B, you might actually, I don't know if it can get.
So it would come into, they would look into
you
it
hold
from
it
an
to the-
aspect of the ownership of it.
Yeah, that's
So
what I was
it's gotta get reviewed by the underwriters, that's kind of key with saying, when you start going through certain establishments, I can say, yeah, but underwriters are gonna look into it a little bit deeper, so knowing the ownership of those companies is what's important.
I know people are doing that to get like legality reasons, and it just makes it a little bit safer.
That,
I
yeah.
don't know if lending wise.
I've seen that exact thing where they're, basically leasing from themselves, and it's, who wants to commit mortgage fraud? It's like, I say, hey, I didn't decide to commit mortgage fraud today, but I'm going to do it.
And the risk is there if you did go through and you try to sneak around it and they did find out, then, do it on demand. So if they find out, then now you owe the full price.
Yeah.
So
Yeah.
that's the risk.
The lending side, I can see that. I know people are doing it again for liability.
Yeah,
Liability, so.
because what it is I've read about this where you're renting as a lease. So basically, if a squatter comes in and these, red state, blue state, different regulations. So sometimes I've seen in different states where if a Airbnb guest stays for 31 days, now they're a long-term tenant. And so if you don't, and then they can just stay there. And then now you're caught. And luckily, it's not like that in South Carolina, but you're just like, well, now I have a squatter on my property, and they have rights now, even though they were short-term under, VRBO or Booking.com or something. So what they'll do is you'll actually have a lease signed as XYZ Holding Company who's renting your property long-term, and you go to the cops and you say, no, there's a long-term lease with this company's name, not this random person who's in my house. So that's kind of what he's talking about.
So I don't know if it can help in the lending side.
Do you ever have, can you talk about any issues that you might experience with finding financing for short-term versus long-term lending?
Short-term, rentals and long-term
Yes.
rentals? Yes. It's really just if your lender will allow you to use the short-term rental income. Because I had to do, somebody referred out a appraiser that I was basically say, hey, and I was allowed to pick my appraiser, and I said, hey, here's the long-term rates based on these comps, and I gave them the 3 printouts, and I said, here's what I need my long-term rental rates to be, hint, hint. And so the appraisal looked at those, and they're like, okay, yeah, I agree with that. So they did give me the long-term rates that I needed, but you can't always do that with your lender. That's kind of not normal.
Well, and I've run into issues just with short-term rentals. They're like, oh,
Yeah. No, I
need a master lease.
I went through 3 lenders just for those properties alone in Park Circle, the short-term rentals, until I could find one that would personally look at it and say, yeah, this is a little risky and as far as a new asset class, and we'll lend on it.
Okay, got it. So just call you.
Yeah. I'll give you guys the plug. All right. Yeah, and the cool thing is it doesn't go on your personal DTI, which is nice. So I have a bunch of these things out, and I can go get a loan for a car or my new personal primary house like Zach's going to hook me up with someday. Cons is that a lot of times they'll do prepayment penalties. So I closed 2 of these recently. One of them had a 5-year, and the most recent one had a 3-year. And the way that it worked was it was 5%, 4%, 3%, 2%, 1%. So it's a 5-year prepayment penalty where if I sold for $200K or whatever the loan balance was, I would have to pay 5% of the purchase price as a fee, which kind of sucks as an exit strategy, but it allows you to get decent debt. Any questions on commercial? Yes, ma'am.
And who did you say you could get those types of loans from? Did you?
I didn't say, but there's lots of them. They're everywhere. A lot of times you can talk to somebody like Zach who does a lot of more conventional stuff. He can point you in the right direction, or you can network with anybody here. A lot of times they'll have them. I use Walton Funding. That's my plug. Walton Funding. I'll give you guys the number to that guy. He was able to do the SCR loans super easy. They have their own bank, and they're able to kind of do what they want.
Okay, thank you.
Mm-hmm. All right, so private money. This is one of those things where I always say to new investors, if you find a good deal, the money will find the deal. That's just the truth. I mean, I found a good deal this week, and the money found it. So go find the money. And a lot of times that'll come from private money, where I locked up a property for $150,000 this week, and we just signed the contract for $200K, and it was a good deal. Money found it. So let's see what we got. What did I write here? Yeah, so private money is just a individual person. So people like to, if you're on Facebook and any of the groups, and then you see somebody like, hey, I'm a private money lender, be a little weary. No, private money lenders typically don't advertise. They're not like, hey, come take my money. I mean, Paul, he does. He actually had a hat with like a little like screen that was like rolling across like an airplane thing. It's like private money lender, and it just was on his hat.
I advertise the hell out of it.
So
Don't trust me.
yeah, he'll give you his money. So, but private money is a private person. It's not like a fund or a hard money lender. So people will say, oh, I'm a private money lender, but really they're just a hard money lender in disguise. So just be wary of those people. Sometimes they'll ask you for money. Never give a lender money before you close, or that's just red flag number one. No lender is going to be like, hey, I need $1,000 to get this loan started. No, it's not a thing. Don't do that. Yeah. But this is one of those things where as you get, I wouldn't say better, but more experienced at real estate, this is going to start to find you. More private money is going to start to find you. So, I know Dan he's probably got a lot. You guys have a lot of private money, right? Like people, investors that are just, looking to, they see what he's doing. He's been doing this for years and years. Got a great track record. So they're like, hey, I got an extra $50K, $100K laying around. Let's do something together. So we use a lot of private money. I think I have like $500K just like from different lenders right now, or private money lenders. Cool thing about it is you can just the Wild West. You can make up whatever terms you want. So if you can go to a private money lender and say 5%, 10%, whatever interest rate you want, you can just do whatever works between you and that person. So, Scott, you guys had an access to some private money recently. What were their terms?
Yeah, it was
5%. That's pretty good for debt, for private money. Just say somebody to write a check for $200K or $100K. That's pretty good. I have some 7%, some 10% out right now from different people. So it's a great way to build a relationship, something that's mutually beneficial. If you have your money in a retirement account, those kind of had a hit this year. People just looked at their retirement and it's like, well, there's 30%. I mean, I lost 30% in 1 month. I was like, that sucks. I'd rather have it in real estate, lend it out to somebody else. So that's kind of a way you could build a relationship. And it is the same as cash again, because it literally is cash. It's somebody else's cash. It's just not yours. Some ways you can get in trouble. Has anybody in here gotten in a weird situation with somebody else's money? Just because I wants to talk about it. No? All right, so I'm going to tell a story of one of my business partners. He had some private money out on one of his flips, and guy calls and says, hey, I'm in the middle of a divorce. I need my $400,000 back now, or my divorce attorney is going to, I'm in big trouble if we're in this divorce and they find out I have all of our money invested and nobody knows about it. So my business partner had to find $400K in a week, just out of thin air. So that's where you can get in trouble. You want to really, really vet vet who you're getting money from, because I'm not going to take anything less than 50K, because the people that are going to lend out less than 50K are going to say, hey, how's everything going? They're going to be your worst investor ever. You're going to want to find somebody that has a couple $100,000 and it's just like, they're just, oh yeah, here you go, here you go, here you go, over and over and over again, because they trust you and they have money, so they understand risk. If you have somebody that's spent 10 years to save up 25 grand and they give it to you, they're going to want to be like, how's my money? Can I have it back yet? Is my investment, can I get return on my money yet? It's just not worth it. So that's one of the things I'll suggest, is just really, really vet where you're getting money from, because it'll blow a deal up. Writing a check for 400K out of thin air is hard to do. All right.
Did you find the 400K?
He did.
Now, let's just get the paperwork that is in the vault. He really didn't have to come up with that.
Right. He didn't have to. He just,
Didn't have to.
he had that person's money.
Should be in place where you know your runway. You know your runway of 4 months, and regardless of that divorce coming up or that weird thing, you as the borrower can just say, sorry, I can't come up with 400 in a day,
Yeah.
in a week.
Yeah.
So he really wasn't forced to do that. So I don't want anybody here thinking that a private money lender will call you and say, I need it back, and you have to give it back, because it just, you don't. You have promissory notes that spell out your time frame and your runway.
Exactly. That's a great point. And on his viewpoint, is he had such a good relationship with that guy. It was just the network, and like, this is my person. I'm using their money. I'm going to treat my investor right. So, but to Kelly's point, yes, absolutely. Like, you don't have to. If you have somebody's money back and like, I want my money back, it's like, sorry, it's going to take me a little bit of time. Or, a lot of times, what you should do is have everything documented and signed in a promissory note, or maybe some interest in the property or something that delineates like what the terms are in your agreement with some random person. So that's what I guess that actually touches on my point where I say look out for your investors. I mean, make sure you're taking care of their money, because that's scary to just give your money to somebody. You're trusting them. And don't let the lack of oversight and underwriting put you in a bad situation where, with Rehab Wallet or a conventional or a DSCR product, they're saying it has to meet these long-term rental standards. With the private money, you show them a deal and you say, this is what I'm going to use your money for, and they're like, okay, no more underwriting. It is what it is. So you really want to get good at this, and I wouldn't recommend just going out and willy-nilly taking people's money unless you have a good deal and you have experience. Any questions on that? All right, this one nobody knows about. What's up?
Just a question. I guess it's a personal question.
Okay.
Would you rather find those private money lenders before you have the deal, or after you find the deal?
It's a good question. When do you set up getting private money? It's twofold. I have done both. I have found a phenomenal deal and then found the money afterwards. I mean, that's what I recommend to the new guys. Just go find a great deal and then go to. I mean, you bring Dan a good deal, you bring me a good deal. I'm like, cool, let's go, let's figure it out. So that's one way. But also, I have people that are set up, ready, where they're like, hey, I see what you're doing. I would love to get in on the next one, whatever. You've talked to them, you vetted them, find a deal, boom, they're already ready to go. I had one, actually, I hopped on a call with somebody today about that, where it's, let me see. Tell everybody what you do. Social media. Tell everybody what you're doing all the time. Show it on social media. Put it on your story. And then they see he's doing what? Boom, 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 boom. All your people from your hometown or people you've known for years and years are like, what's this guy doing? They want to be a part of that. They see there's some traction, some energy behind it. They're gonna offer you money. You're gonna have people, once you get good at this, just give you money. I've had it happen. I'm new. I'm not that seasoned. They'll just start giving you money because they see what you're doing.
Hey, and if I could, one quick thing is this just happened literally 2 weeks ago. Someone promised private money. Just always have a plan B is what I'm gonna get. They promised private money.
Yeah.
400,000. And hit me up. We ended up getting it to them about a week. Ended up lending them 320 grand on this specific deal because their private money lender backed out. They almost lost the deal. They were extending closing another 2 weeks, but that happens. I don't know how many times I've lent out money because of I'm too expensive, and I get the call a little bit later because guess what, the deal falls through the private money. So just make sure you have a plan B is all I'm getting at. Private money's great, but especially if they haven't invested money before, they usually get cold feet at the 11th hour. It happens a lot.
It's very true. I mean, it takes a lot to call your bank and actually wire the funds to somebody else. Abby?
Can you talk about how you navigate around, like, let's say you find a deal but you don't have your investors yet, but the seller wants to see proof of funds, or they want to see, like, how you,
It's the.
you're not going to be like, well, I don't have it yet.
That's why I'm not a realtor, because I like to operate in the gray area. So I'll find somebody that will give me a proof of funds. Yes, everybody.
I'm a realtor and I operate in that gray area.
Like some people could get in trouble. I'm just like, I'm finding a way to show proof of funds. I'm gonna screenshot somebody else's bank account. I'm gonna get a letter from. Get a letter from a hard money lender. I have a lot of my hard money lenders. They'll give me a letter. So you just like show proof of funds. Proof of funds should never stop you. So I'm getting at like.
I'm gonna see your backup. The private money lender will give it to you. Yeah.
I'm in trouble with my wife now. Yeah. They're never lending me again now. You guys are never going to lend to me. So something to Dan's point with 11th hour people backing out. We lost out on our biggest deal we ever had last Friday. Tyler, you want to tell us on how upset you are? Yeah, Tyler already spent his commission already, but so the deal was we're supposed to make over 6 figures on this one deal, and we were very excited about it. The buyer was like, hey, everything's good to go. We're ready to close. I spoke directly to the actual lender. Lender's like, hey, we're going to close this early. We're ready to go. And then got to the closing table, and they said, hey, we can't get the down payment. I'm like, what do you mean? Like, we already extended a week. This is, it was 1 o'clock on a Friday. I'm sitting at the attorney's office about to use transactional funding from another hard money lender to close this one deal to make a couple $100,000. And then they're like, oh, can't get the down payment. Had to kill the deal, lost out on everything on the 11th hour. And they were getting that money from a self-directed IRA. That's where they're supposed to get it from.
How much money was the down payment? It's your profit. Give them the down payment as a loan.
I tried I was gonna put a.
I'm looking through my call history and I don't see a phone.
So I'm in trouble. I'm so.
You got friends, man.
Rehab Wallet is mad at me today. So, a self-directed IRA, does anybody know what that is? Who's familiar with this? Yes, sir. Can you tell me a little bit about your experience with them? With that self-directed?
I'm with Advanta.
Okay.
I've got 2 with them. It's, both of them are Roth-based. One's a solo 401k, and one's a 2 or 3. Is it? I'm getting my numbers messed up.
There's all different types of terms for the, 401k, self-directed.
But the main idea is it allows you to invest that money into something that you know about, that you control. Real estate is allowed. That's the thing.
Yep.
So, and if you put the money in after having paid tax on it, and you invest it, and that profit comes back into it, that profit is tax-free. Not tax-deferred, tax-free.
This is an absolute hack. This is a life hack. So I just set one of these up this year. I took my wife's retirement, I stole it from her, put it into the self-directed. I put my retirement from the Navy, not my retirement, but all my money from the Navy when I was in, took it all, put it into a self-directed, and we just lent it out to somebody who's a developer in Ohio. So they're actually using our money and our retirement account that I can't use till I'm 60 or whatever, and then I'm going to get a return on it tax-free. So it is so powerful. This is, if you can teach people about this, people don't even know that they can use their retirement to invest with us. So if you can teach people, hey, how much money you got sitting in your retirement, you should talk to this person, and they'll hook it up, and then you can actually use that money for investing. So the only problem with, not problem, but one catch that I think is right is you can't use it for yourself. So you can't
be actively involved in that particular investment.
Yeah.
You can just say, I want to invest it
Yeah.
in this.
So I took my money, lent it out to some developer. I'm not in that deal, but I can't take that money and use it in my own project. So exactly right.
You can use it for a wholesale deal, earnest money, earnest
Yeah.
down.
Okay, you can do something like
yeah,
that.
you can't take it down.
Who uses specialized trust in here? Me and Dan, Whitney. She's this. Amanda. That's she.
I get it mixed up.
So yeah, I love it.
Say you want to like to just kind of piggyback off some of the previous topics. If you're raising private funds, you're going to want to ask your LPs where they're sourcing their funds from, because if they're getting it from a self-directed IRA, there's timing associated with that. You're going to need to make sure that them being able to pull the funds out of that lines up with your close date.
And that's what happened. That's why we missed out on our deal. Is they said, hey, we need another week to get the self-directed money, and I said, seller is not going to give us another week. We already extended once, lost it on the 11th hour. So
for Rehab Wallet, you can, if you don't have enough money in the IRA, if you're buying more expensive property when you're not, and you're looking at, let's say, you can borrow using that money, but the IRA has to do the borrowing. Like it has to be the customer. It can't be you personally borrowing, but the IRA can borrow money. There's tax implications down the road after that possibly, but you can borrow money. Have you guys ever done that? Have you run into that?
My
Most
older
of those-
sister's shaking her head yes.
Most
Go
of
ahead,
those
Derek.
loans, they have to be non-recourse loans, and we
Right.
only offer recourse loans.
Okay, they have to be non-recourse, for sure.
So you wouldn't be able to do it with us, but you could potentially do it with another lender.
Okay.
Maybe, after what's been going on.
Yeah.
That may be going away.
another really cool thing about these is you can actually wholesale into them. So I can take one of my wholesale deals that I do. If you guys don't know, I'm a wholesaler as well. I'll basically take that fee, put it right into my IRA, and it's tax-free. It's really cool.
I'll give Russ a little plug here and also share testimony on behalf of my cousin who uses her self-directed IRA. But she's a single parent, adopted 2 children overseas, and now has about 5 years moved back to the U.S. And the money that she had saved and had in an IRA, early on I put her in contact with Russ for her to learn how to use the self-directed IRA to invest. And in this case, she does it in passive investing. She's not doing deals. But she has the ability now to work part-time as a school teacher in the U.S. As a single parent, and the investments that she's been able to generate monthly or quarterly dividends from help support her while she gets her young children through school. And works part-time, so it's very powerful. And as I've seen what she's been able to do with it, with a little bit of guidance from Russ, has been life-changing for her.
Like Abby and Kelly had a syndication deal that they were syndicating. So somebody could come into their syndication, or some of our partners at PassiveInvesting.com, you go in their syndication, as long as it's in the name of your self-directed, like you were talking about, the self-directed IRA, the name of it.
Yep.
And then all those distributions, those prep payments each month go straight into back in our IRA tax-free.
So if you guys, you can either look up Specialized Trust, or you can get with me and I'll give you the number directly to the person that set mine and Dan's up. She's phenomenal, and she'll kind of answer all your questions. She's got a bunch of YouTube videos. If you look this up, Amanda Holbrook, she basically explains everything and kind of walks you through it, because I can't talk about it like she does, and she's great at it.
Question, are there any penalties associated with using that money that you know of?
I'm going to defer. I don't know. I don't think you can't, like, you can use it. There's penalties with,
59.5 is when the penalty happens.
Yeah.
Then you have to start using it at 70.5, or it's penalized 50%.
but as far as using it to invest, like, you just pay your, like, fees associated with the service. You're not, like, penalized tax-wise for you self-directing your IRA.
Unless you use it incorrectly, then they can go back after the whole thing. So you gotta be very careful of how you're utilizing it and making sure you're done by the books. From my understanding, I'm not.
The same thing. Yeah.
Yes.
The qualified IRA, just like you would if you're investing in your 401k, you can't, you're not taxed, but your fees before you're through that age.
If you guys are,
30 more years.
So we're looking 506.
Yeah, 506.
if you're wondering, Whitney, what does this say and this say and these crazy?
Song? Says 506 B and 506 C.
Yeah. Okay. So she edited this right after. So I didn't. Yeah, the meltdown. We wrote this together this morning. So. Yeah. So syndications. Abby, can you tell me about syndications? Because I don't know anything about them. I'm just kidding.
I can tell you about 506Bs.
Okay, please.
So basically, raising private money. There's two ways that you can do it. You can do it through your bros and blood, which is 506B, so people you know or family. And then the 506C designation is for accredited investors, so people that have a net worth of over $1 million.
Yeah.
And
200 or 300 is a couple.
or 300 as a couple. We did a 506B.
And then we couldn't advertise or anything.
Correct, you
Again,
can't
all has to
advertise
be through
it.
Friends,
Mm.
family.
Yeah, it's kind of word of
People who
mouth.
already knew you.
Yeah.
So that's interesting getting that out, right? No advertising. So it's interesting when you try and, spread the word on that, right? You have to know the person to have the conversation. You can't really talk details about the deal, unless it's somebody that has expressed interest in wanting to, oh, now I know you. Okay, so you have to kind of be careful with that. And then, just make sure that you have, a syndication attorney that can file the appropriate paperwork. Make sure that you're building that into your costs, because that's expensive. That can be between $12,000 and $25,000,
Even more, yeah.
depending on the attorney that you find.
Yeah.
And they'll file all of the appropriate paperwork with the right, regulators.
Yeah.
They'll make sure that everything is, signed the right way and all your LPs have signed paperwork the right way. They basically do all the legwork for you. So, but yeah, we syndicated our mobile home park.
Yeah. So.
Explain one.
Yeah, so we bought a mobile home park February of last year. By the time we purchased it, did some value add. By the time we were ready to go back to the bank, which we had had conversations with before we even purchased the mobile home park.
Very excited about it. They were
Yes, they were
very
very
excited
excited.
about
Please
it.
come see me. Please come see me when you're done. We want this loan.
Yeah.
Okay? So we went to the bank and they were like, this was like around June, July when the rates started climbing last summer. And they were like, no, thank you. We don't want that asset. It's, no, thank you.
And then keep them on your hard money loan.
Yeah, we're not hard money loan.
Yeah.
And so now we're like, oh.
Yeah.
So we had to extend for a little bit, and we had to figure out, I think I called 30 plus lenders to try and find.
Correct me if I'm wrong. We were at the REI group with Tim, right? Is that when
Yes.
Yeah, so we were just at the REI group, and Abby, you could see she's like stressed. She's just like, and then Kelly is like, there was a guy there that has done these a lot more, and Kelly's like, hey, tell us about your deal, and kind of like got her to talk, and then Tim like, here's what you do, boom, 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 and then basically set it all up, ran with it, and sounds like it worked out.
Yeah, we raised what we needed, and it took some time because we'd never done it before.
Mhm.
How much did you raise? I'm like, I push this stuff out of you. How much did you raise?
We raised $450,000, and then we brought the remaining balance in for the original bank that said, "Come see me." They came in for like a land loan for the remaining balance,
Nice.
which was great. So we closed it in December. We bought it in February. We closed it in December. So just a couple months ago, and so it was really exciting because it was.
It was a pivot. It was an answer to a problem that you had no idea how to do until REI Central on the back porch.
Yeah.
Walking through it, of course, knowing everybody
Yeah.
to figure it out, who you are, and figured out how to get it done. It was amazing.
It's a cool story. I mean, that's
That's awesome.
It's a great story.
Yeah, it was. It's a lot. It's more fun to talk about it now.
yeah. Oh yeah, I could see. She was not happy.
That's, you know, I mean, one of the questions was, how do you raise the money after you found? Like that was after we found the deal. We had to go find, some private money investors, and some of them were like, "Well, what are you doing to the property?" And I'm like, "Well, we already did it."
Yeah.
So,
This is it.
Yeah.
That's why you're getting.
Yeah.
But look at how much money it makes. So.
Yeah.
I mean, it's a great asset.
Yeah.
It's just our timing was not right, and there was nothing that we could do to control that. And so, with our backs against the wall, we
Jumped out of the plane and built your parachute on the way down.
exactly, and ended up realizing that I thought once we finally got past the I don't know how to do this stage, I would prefer to do syndication over a bank.
Yeah. So I've never done a syndication before, but it's a tool for, she said, $20,000, $30,000 to get it set up and do it correctly because there's a lot of regulation behind it. You can't just go borrow people's money for a big apartment complex and do it legally and not get in trouble. Like there's a lot of regulations behind it. So there's these different funds that, you can set up and protect yourselves, make sure everybody is understanding of the risk and everybody's covered. And it's just a group of people, they get together and they invest in a single deal. And it's a great way to scale.
Yeah.
Tim?
So if anyone's like doing bigger deals, commercial, multifamily, or whatever, and someone says, I need a proof of funds, just say I'm syndicating, and that'll shut them down, at least in my experience. That shuts people down.
Yeah.
It's like, I don't have a proof of funds for $10 million. Like, are you crazy? I'm going to be raising the money. And
Yeah.
like, that's
Yeah.
great,
It's like there's the steps that you go in a ladder. It's like, hey, I'm a single family investor. You get up into the mobile home parks, the apartment complexes, and then people start speaking a different lingo, and then they're way more understanding. And we're talking through a $16 million single family portfolio right now, and I'm just talking to a bunch of these investors, and it's just the lingo and everything is just another level.
No one asked you for a proof of
Nobody
funds.
asked you for a proof of funds for $16.5 million. No.
Even if you don't know, I don't know shit about syndication, just say that, So you're talking, hey, I'm interested in taking a big deal down. I don't know how I'm going to do it, but that's almost like sometimes commercial brokers will be like, this is kind of my gatekeeper. So I was talking to someone about this earlier yesterday. They said, I didn't know what to say, and I said, you just tell them you're syndicating it, They're just kind of calling your bluff. And at that time it worked, but next time it won't. That's okay. You learn.
Tim's got some nuggets.
I like that.
Yeah.
It's the answer to all those problems.
You said you never syndicated.
Correct.
But you have a pool of
Cop stops you, they're like, I'm syndicating.
large sums of money into one single deal.
So I have a few different lenders that we basically just have like not a promissory note, but just a line of credit maybe. Like somebody's.
But one person is in that deal.
They're not attached to the deal. I basically have a loan with that person.
Just a personal guarantee.
Just some of them are invested in specific deals where they're like, hey, we have $200,000 we actually have $200,000 in our Park Circle Airbnbs of other people's money in that deal alone. And then I have basically like a line of credit that we're talking about, where I just have X amount of dollars that I can just use for whatever deal I want. So you can structure it any way. That's the cool thing about private money.
I was just gonna ask why you would choose to do one over the other if they were all in that one deal, but you're pulling from that line of credit for whatever goes in.
Yeah, yeah.
I think once you combine, how many people is it?
Yes, once you start combining people in a deal,
Yeah,
you
so
gotta
once
do
you
a
start
syndication to
combining
protect
people, you have to do a syndication, well, you're.
Right. So if you start doing sketchy things, so you can go in with like a way to do it is like you're both purchasing the property together. So if that's like one way is like if you're partnering with somebody's bringing the money, you buy a deal together. That's one way to get around setting up a syndication for like a single property. You can just buy it together. You're both on the deed. You're both protected. You both have the risk.
But it would be different, for instance, if you maybe got 3 or 4 different investors in a property and maybe they didn't want to be actively involved, they just want to.
Yeah, if you got a bunch of like random people's money and they're all LPs, and it's just now if you get caught later in the line, say you do one of those, and then 6 deals later you're doing like a huge apartment complex and something goes wrong, they pull the string all the way back to your first deal, and now they're unraveling your whole story. So that's why you want to do it right from the beginning.
I don't know if anyone knows about it, but Grant Cardone did a syndication for an apartment complex in Houston.
Sounds about right.
I think it was in Florida, actually.
Yeah.
Florida or Texas. But he advertised it.
Yeah.
And he was saying you can come in with as little as like $1,000.
I don't know. I saw that too. It was like a high rise in Miami. Basically it was this huge thing. I don't know how he did that. He probably had.
It's a segment off of the 506C.
Okay.
And Craig cost him millions of dollars to put all that together.
Yeah.
And he's not afraid of the eyes coming on top of him, but the SEC, he's got their eyes on him already. I mean, he's just that big. So he's got got his eye across his T's on every single thing when you're pulling from somebody with just $1,000.
Yeah.
Yeah.
It's like crypto.
Yeah, 506C is the accredited investors, and then 506B is the
Bros.
just whoever you're talking to word of mouth. But I've actually seen them advertise it.
Yeah, that's something I can't speak on.
Oh, hi, nice to meet you.
It's also a good point though.
Dan, what you said?
Syndicators, being careful who the syndicator is, like, and making sure you know them and trust them. And
Yeah.
I think syndication's thrown around. It's just I'm sorry, I'm cautious a lot. It's thrown around. Anybody who's seen was it Arbor Group?
Yep.
Arbor Group, $229 million Houston, Texas syndication. I got taken back with some big names involved in that.
Yeah. That guy fled the country or something.
So yeah, it's like just know your syndicator. I know Kelly's been great at that. She knows the people, really knows them on a personal level before investing. I think that's so important.
I feel like we need to touch a little bit on like K1s and setting aside the money and for preparing that.
Floor is yours.
Yeah, we're listening.
I don't know that much about it, but if you're doing a syndication, you have to prepare K1s or pay some money to do that. So you have to consider that.
Yeah.
When you decide to do a syndication.
Yeah.
So K1 tells you what you made or didn't make, right? And so when somebody's getting their taxes, they're calling somebody like Abby that's syndicated, okay? And a lot of our partners calling them and saying, where's my K1? Hopefully we can get all into it, but some syndications do like depreciation. That is a big key for any of Dan, me, Ange, anybody, Harris, anybody that's in any syndications, you guys, that go into a syndication. I'm doing it for a lot of reasons, and one is the depreciation. So that syndicator needs to know how to do that, and you get a K1, which is just it's a document, and it has a negative number or a positive number on how much money you made or how much you lost in that syndication that you then take to your tax person and roll it into your personal taxes. So
It's your share of the little portion of.
yeah, because you're a partner. You're it's not just Abby's deal. I mean, I invested in that deal with Abby. So, Paul, I think you did too. I think Harris did too. And so you go in to that deal, then I'm a partner with her. She's over there dealing with it, but I'm a limited partner. I'm gonna sit over here quietly and not ask her a bunch of questions, but when it comes tax time, I need my K-1.
Yeah.
Yep, to do that.
But I have the responsibility of managing it and, paying the, LPs, and we pay monthly. And so, and then reporting like the books each quarter.
Yeah.
So,
There's a job to do.
Yeah.
There's a job to do. It's not just getting their money and be like, whoo, okay, I got this deal. It's my deal and only my deal. It's not. You're stewards. You gotta be a steward of your investors' money.
Yeah.
And this portal's on so Invest Next or Syndication Pro. They'll go through and they'll track it. People can sign in, have their own portal there to see how their money's doing, if you want to compound the interest or get dividends. So I use Invest Next. I mean, Syndication Pro is another good one. And so there are ways to do it, but you got to do it right.
Kelly, if you pay out on private investment, are you theoretically supposed to do that as well? If I pay somebody $10,000 for private money, in theory, you're supposed to report that most likely. They're mostly off the books.
1099 or 1098?
Are you talking about the interest that you make?
Yeah, so if you pay someone $10,000 in interest, just 1099, okay.
Yeah. So I had to issue 1099s to a lot of my money that I had out this year. So I just issued them, hey, here's how much interest I paid you over this year.
So is a syndication like a legal entity? Is it like a legal?
It's like a structure, like a legal structure, right?
yes, it's structured as a legal entity. Yep. And then you just have partners that have different volume of, or percentage of shares, right? So each, like the GP will be listed, the general partner, and then you'll have all your partners, and all your limited partners, then they'll have their share. And it just explains in the entire, it's called a PPM, it's like over 100 pages, right?
Some light reading.
Yeah.
Yes, my other thing to look at.
But yeah, it shows the entire structure, and it shows what you're getting into, and, I mean, you're signing all of this paperwork and stuff before closing, and you sign an operating agreement, and so, it's a lot.
Yeah, Whitney's in charge of reading all that for me, so.
Yeah,
That's what the attorney does for the 12 to 25 grams. They know all those documents.
They put all
They'll do the PPM, they'll do all that.
So you can't go online.
You don't want to go online. You pay an attorney. You pay an attorney.
Yeah, it's worth it.
Oh, yeah.
We'll be in hot water real quick.
Liability.
All right, any more questions on syndications and kind of raising money and doing different stuff?
This was a super interactive.
Cool. Well, I'm glad. Okay. We're not. No, this is the best part. We got a few more minutes. So this is probably a whole topic on itself. So creative finance is my new favorite thing. I wouldn't say new favorite, but it's amazing what you can do with creative financing. When I all of those slides beforehand are ways to get money. This could be your one answer for everything. It could be, I'll tell you about my deal that I just did. It's really cool. So I bought a house in Somerville it's a 432 Cooper's Hawk Circle, if you guys want to look that up. Bought it for $525,000 under Subject 2. So I basically went in there and I said, hey, the real estate agent actually proposed the deal to me, which is mind-blowing. But they said, hey, could you take over the loan, take over the payments on this property, and then we'll sell it to you. You just bring like $20,000 down. So that's what I did. I brought $20,000 down, and I bought a brand new house that was built in 2021 with a 2.7% interest rate. So you talk about like capitalizing on the opportunities from 2021 and those 2% interest rates. Okay, so there's two separate things. So for Subject 2, Subject 2 is you're just buying the property subject to the existing mortgage. So you're not actually on the debt. Your name's not tied to it. You just take it over, real fake. You don't actually, you're just paying it. And so I just got sent my power of attorney today to the loan company, because I just bought this like last week, to the loan company that gives me permission to pay their loan and act on their behalf of the old people that actually hold the mortgage. So now I'm coming in, I'm going to log into their account, and I'm going to pay the mortgage every single month, or I could put it in like a servicing company, but it's already in a servicing company. But assuming the loan is where you actually qualify for it, and then you assume the same terms as the existing loan. So VA loans are assumable, a lot of them. So you can actually go to that bank or whatever, and you go through their paperwork. Zach has a property that has an assumable loan on it that he was trying to sell. So if you were a veteran, you could actually use your VA loan, go assume that, and actually now your name's tied to the debt. But for subject to, your name's not tied to it.
And
But-
then what happened, so you're paying their mortgage,
Mm-hmm.
and they are paying you.
So the way that this one worked out is purchase price was $525, their loan was $405. So if you do the math on that, $525 and $405, if they would have paid buyer and seller commission 6%, they would have had to actually stroke a check to sell their property. So I came in and said, hey, you don't have to pay buy side commission. I'll pay your realtor and I'll give you a check. You'll make money on this deal. So I was an answer to them. So I own the deed. My name's on the deed. I own the property, and then I'm just paying their mortgage.
But they're on the hook if you don't pay.
Exactly.
Are they still in the property?
Hmm?
Are they still in the property?
Well, they're currently renting it from me for till the 28th of this month.
Are you worried about taxes?
Taxes?
I mean, because you changed the name on the deed, right? You're on the deed now?
Mm-hmm. Yeah, I'm going to pay them more taxes. I'm not going to pay the 4.5% or whatever.
So did you keep their name on the deed, or?
No, I own the property.
So what happens with them if, I guess they're kind of screwed if they want to buy something else because now they have this debt? Do they have to go through, are they able to show?
That's a great question. What I did is they were buying a house in Tennessee. I actually talked to their lender and said, here's the situation. It's kind of like a lease where I'm paying for their mortgage. So they're on their DTI, you should take that line item off because it's covered for. And the lender's like, okay, good enough. They talked to my attorney, not just me, but my attorney was like, yeah, you should approve the new loan. They got approved for the new loan and they're moving. So, yeah.
If their name is no longer on the deed, isn't there a chance that the mortgage company will call the loan?
Exactly. There is a big chance that's one of the problems with subject to is if I go and how do I say this? If I go like switch their insurance, say they cancel their insurance, and now the insurance company notifies the mortgage company that there's no insurance on the property anymore, the mortgage company's going to be like, your loan's due, because now they're going to see that it's called. So there's a bunch of little loopholes. That's why this is a whole topic on itself. But basically, there's things you can do that can stop the due on sales clause from happening. So yes, technically, they sold the property, loan should be due. But they're not looking for non-performing loans. Banks aren't out there like, they're just happy their mortgage is paid. So that's kind of, these happen very, very frequently, but they're not going to go looking for a problem if there's not one.
So you said you
I didn't. I might switch it over. But what I did is I had a, it's called Constant Close, where I paid a transaction coordinator to write me up the contract, do everything, do the power of attorneys, set up the insurance, do everything for me, get it from A to Z. Everything for me is $1,000. So if you guys want to use Constant Close, they'll walk you through your first transaction. So that's what I did. I said, I have somebody that's going to agree to a subject to deal. I don't have the contracts. I don't know all the ins and outs of it. They took care of the whole thing and did it for me.
What did you use the POA for? When I did a subject to, we didn't get a POA, but I think that was because she knew me personally. So what exactly did you use the POA for?
The power of attorney got submitted to the insurance company and the mortgage company so that I could call up the mortgage company and I can act as a property manager, is what they told me to say.
And that wouldn't be like a red flag going back to?
No, because I'm just the power of attorneys happen all the time, where I got a power of attorney to help somebody through foreclosure. I had to, whenever you try and, if I tried to talk to Tim's bank about his loan, they're not going to talk to me. So I have to get a limited power of attorney in order to be able to talk to their bank. So that's what I used it for, is now I can talk to the loan, the mortgage company, and the insurance company.
On our deal we were keeping it, they were keeping it for a long period of time. We just flipped it, so I wasn't concerned with doing anything additional. I just needed her to get in her account and make her payment for the 45 days that we owned it.
We just had her like get on the phone.
Yeah, yeah.
I just didn't know if that was risking them calling it due if you were acting as POA and
Yeah.
what's going on.
The words they said was basically, I could probably read the email that I'm filming, but it basically says, as a property manager is what they told me to say when I called or whatever. So.
It's very, very speculative. Since it's happening right now, what if the bank fails or whatever? What have they got going on?
So if banks fail doesn't mean you're not liable for the debt. They might call it due. They might sell. There's tons of different things. Like there's lots of scenarios. I don't want to go down the rabbit hole. I'm not like super familiar about all the ways that it can happen. But for the deal that for Rio Street, the one we just did, their mortgage company went out of business. Their mortgage company failed. And they told me when they were selling, they said, hey, we don't know what happened to the mortgage. It just disappeared. But it's still tied to the property, but the mortgage company went out of business. So we either have to go through a quiet title action, or we have to find the rabbit trail, go find all the crumbs, and go back to somebody that can give a satisfaction of loan payoff. And we found Ally Bank. They're going to give us the letter to satisfy the loan that went out of business.
Was that loan they sold to Ally Bank?
I think so. Is what happened. Is what we figured out. Yeah. So there's tons of things that could happen when banks fail. I'm not like worried about it, but that's what happened with the situation that I experienced.
There's also government backs, that comes into play, right? You get a VA.
Typically, the
Yeah, you get a
FDIC
VA.
will just come in and seize it. I mean, we had a bank we had a big loan with during the crash in 08, 09, 10, and literally the FDIC, they came in with guns drawn. They just literally took the bank over and just ended up selling it to another bank.
Yeah. So the cool thing about Creative Finance is I went in with no money, no credentials, and bought $500,000 home, and now I have a cash flowing asset that was built in 1 year ago that has a 2% interest rate that I'm going to own for the next 30 years, and I have all that debt in place, and I didn't have to do anything for it. I brought $21,000 down payment. So I get,
Monthly cash flow?
depending on where we rent it at, like $500 to start, and then it's going to go up. But I think their mortgage is like $1,800 or something super silly, right? Like on a $500,000 home right now, that would be like $5,000.
Yeah.
So now that's what's cool, and this is a strategy that I'm implementing for my business. So if you guys want to steal it, fine. But I'm looking for all the low equity properties in the Tri-County area to see if I can find somebody that doesn't have any equity in their property, and it's any home that's been sitting on the market for greater than 100 days with low equity. I'm calling them, trying to take over their shit.
It's not yours, it's Pace Morby's. Come on.
Okay, thanks.
They're starting to advertise some of these listings, assumable mortgages and stuff.
People are doing it.
Correct me if I'm wrong, 'cause we're doing this right now, so we better be right here, 'cause we've asked London 5 times. A VA loan, it's not that. A VA loan, even it's a VA loan, but my client buying the house and assuming the mortgage is not VA.
That's fine.
And he's able to assume this mortgage at a 3.2% rate right now.
100%
We have a deal going
financing.
on right now. We're assuming their mortgage right now, and it's a VA loan, and it was advertised as that. So we got some realtors are starting to advertise it
Figuring it out.
because they realize the power in that interest rate right now.
Yeah.
So just call me MLS and take a look at assumable.
The risk there only falls back on the vendor.
Yeah.
The risk there just falls back on the seller, the VA, because his entitlement will be tied up in that house.
Correct. So that's why we actually did a clause where it's in 5 years, he has to have an exit strategy of a refi or whatever to help release that entitlement.
Yeah. So you do like a balloon payment. Like that's something that we do too. Is I'll say, hey, your next duty station for all these military people, you should be there for 4 years. So you're going to rent for 4 years, and then you might want to buy a new house. I'll put a 4-year balloon on the 30-year debt, and I'll just pay it all off or refinance it at that point because the market hopefully goes up, and I can get enough cash flow, pay the loan down enough, and it'll work. So.
They can refi it subject to?
Yeah, if I want to go and clear the debt that's in those other people's name right now, I can refinance the property that I own. I own it. I can refinance it, and it's going to clear out that debt. Because you can't have two mortgages on a. Okay, I'm going to say something that's incorrect, but if you have your existing mortgage, it's tied to that property regardless. Like it doesn't just disappear. If I go to refinance that home, it's going to have to clear that debt out.
How
Cool.
often do you see that with VA loans, Zach?
It's becoming more now. The big problem is a lot of the VA loans and the buyers that are using those are utilizing it for a zero down. So that veteran sells that to our VA, the entitlement transfers over. But if the house is being sold for $500 and the loan's $400, there's a $100,000 gap you got to make up. So they would either have to bring 25% of that $100,000 as a down payment. So they either got to have money to bridge the gap in some way, or you can't do the full zero down.
We can all network here in a little bit, but another cool thing on the creative, that's just one strategy that's subject to. Another one is owner finance. So that's the opposite book where I'm looking for low equity. Owner finance would be high equity, where somebody owns their home free and clear. So that's two marketing paths I have. They don't have any equity in their property, but they have all the equity in the property. Then you can just put a owner finance mortgage in place and do that strategy as well. So we'll do our next meeting or the next one after that. We'll dive into creative financing in depth. Cool. Any last questions before we network?
Thank you. Great job.
Thank you. Thank you.